Hello, everyone, and welcome to the Parham Team and Highlands Mortgage today. We are going to talk to a real estate professional. Here to join me is my production partner, Eleanor Staley, and today we're going to be spotlighting Melissa Nash. How are you, Melissa?
Hi, good, thank you.
Just to share a little brief information about Melissa, she is the founder of Lady Luck Investments, a company dedicated to helping individuals achieve their financial goals through smart investing. She's helped over 500 students to grow their inventory over $200 million worth of cash flow properties. Outstanding. She attended USU, where she majored in communication, minored in art. Today, she lives in Orange County with her husband and 4 children. We're going to talk about those as well. And she's also a philanthropist who started a nonprofit organization back in 2013, which has helped clothing foster children in her community, which is outstanding. When she is not working, she enjoys photography, watching musicals, traveling, and teaching her kids how to become real estate wealth providers as well. During her last 5 years of doing this, she's been able to achieve close to $4 million of her own personal inventory in real estate, which is outstanding in a very short period of time. Welcome, Melissa. That's also great.
Thanks. It sounds so great, all put together like that. I appreciate it.
Well, I've known Melissa for years, and I got to tell you, she's one of the top professionals. I mean, and nothing against male or female in this business, but if you're a male or female in this business, you better know what you're talking about. You better be good, because you got to convince your listeners that, hey, I know what I'm talking about, and for a fact you do. So tell me a little bit about yourself. When did you get in real estate?
A good question. I always tell people that I started investing 20 years ago, but I didn't know what I was doing. I made a lot of mistakes and a lot of errors along the way. I just knew I should be investing, but I didn't really understand why and all the benefits of real estate. And so I think that allowed for a lot of errors. I also didn't realize how you need to build a team around you. For example, lenders you guys are very, very important and a very essential piece of that. Without you guys, I wouldn't have known how to grow my portfolio. There's definitely kind of strategies there, like, okay, great, you want to buy it, but how do you do it on the financial side? Then we've got other professionals like the CPAs. I've invested heavily with CPAs who said, hey, this is what you need to do. Just listening to other people help me build my team and help me succeed. And I think that was the biggest thing. And then, of course, investing in yourself and education and all that good stuff. But I think it's bigger than just yourself. I don't think, like, I could not have done it, and I don't do it with my students. I do rely on a team of people to help them succeed. You have to do that.
True, true. It's interesting. I got in this business about 17. Well, in the lending business, I got in about 25 years ago. My personal investment started doing about 18 years ago, because I kept seeing tax returns were coming across my desk. I'm kind of going, what do these people know that I don't? Nothing. They're just doing it. And so
Yeah.
that's all good. And so, but yeah, you can obviously make mistakes, and I've made them. I've seen my clients make them. And if you don't have the right people on your team, you will make those mistakes. Keep going. And the great thing about working with you, Melissa, obviously you can share these things with your experiences with these clients. And I'm assuming once you do that, they kind of go, oh, that's great. Am I right?
Well, exactly. And it's not only my mistakes, but you're absolutely right. I mean, I'm definitely able to share like what I've learned and what I know. But each client that I work with has their own successes or failures or fears or reasons that they invested earlier or later in life. And so I'm able to continue to learn and teach new students based on past students' experiences. So it's just this ongoing, evolving machine of continued knowledge, I guess, is the best way to explain that. We all essentially learn from each other. And even though, client Joe doesn't realize that his story has helped client Jane,
That's a
But that's
perfect.
how it works.
Yeah, that's a perfect analysis. And one of the things that you mentioned earlier on when you were explaining that is about the how to make sure you have your finances straight, and that is a key thing. All too many people, come to you and they buy a property and they get a loan, and then they put husband and wife on there and they're all happy because the wife
Yep.
wants to be a part of it. Okay. But then again, they get up to they want to grow the portfolio. And next thing you know, they hit that Fannie Mae wall, and now they have to go into a different type of category, which when I'm consulting with them, I always tell them to split it up if they can, because the wife can do 10 and then the husband can do 10, and they can still go in the same title work. So it doesn't take away from one of those slots, if you will, from Fannie Mae. So yeah, that is important. It's very important. The other thing is, I noticed once that we had a client, Aaron. I don't even know if you can remember who it was, but he wanted to do everything on the 15-year loan term. Okay, well that's all good and fine, but next thing you know, that loan term is going to catch up with you on paper, where you eventually can't qualify. And so anybody asked me that, I said, look, just do it on the 30-year. I can give you an amortization schedule, show you how to pay it off in 15 if that's what you really want. And we've seen that all too often because
And yeah, and even to pile on top of that, agree with the same point, Graham. We've seen those 15-year rates be far worse than the 30 in regards to investment property for some time now, with all the volatility from COVID and rates kind of rising after that. So 100% agreed there.
yeah, it's the ideal product is still the 30-year fixed rate. So, Melissa, somebody new. I'm going to send you somebody new, never done investing before. Tell me how you approach them, and they obviously do. You just explained you got to go through their needs and what they're trying to accomplish. Kind of tell me what you go through.
Yeah, well, there's a different type of clientele, and the first thing that I like to talk to people about is, what are you trying to do? What are your goals? I need to be able to know, some people are like, hey, I just want to make a little bit of extra cash to go on a couple family vacations, or this is for retirement, or, like everybody has their different goals. And I have to be able to kind of, a lot of people don't realize what their goals are actually, and they just know that they want to invest in real estate. And so I think goal setting and kind of understanding what you're trying to do and setting expectations, because this type of real estate it's not the most exciting, sexy thing. Like, you're not like, woohoo, I bought a property, I'm cash flowing $2,000 a month. Like, it's really not. It's a long-term strategy. And some people just get caught up in that whole, YouTube real estate, I'm going to buy a Lamborghini thing. And there's so many hidden values of real estate. And so that's one of the first things that we do is we set expectations and try to figure out what they're trying to do. Then we start to analyze the markets together. And again, setting those expectations on what are their fears? What are they afraid of? Are they afraid of a bad tenant? Are they afraid of not enough cash flow? Are they afraid of not, everybody has their different expectations, or, fears or sleep factors, or whatever's going to keep you up at night. So we sort through all of that. And if somebody's saying, hey, I used to own real estate, and I was out there fixing toilets, and what I mean, all that kind of stuff, like we're resolving all those issues, because the real estate I work with is passive. You are an investor, you are not a landlord. We have property managers in every market that do everything for you. So basically, the expectation is, what I believe for passive real estate is, you're buying a property that's been newly renovated, in a market that has some type of cash flow, any market that has some type of appreciation, with a property manager in place. Then from there, we can kind of get into the weeds of the markets, and that's the fun part. We kind of dive into that, and then we get them pre-approved. That's always the first step, because it's really hard to go much further if you don't know what you qualify for, and if you qualify. And that's why we love working with you guys, is because you're qualifying them so that there's no questions asked at the beginning. Like, we know once they talk to you guys, once they put in that work at the beginning, you guys ask for a lot of stuff up front, but once you guys have all that, they're going to close on a property, like done deal. And so having that confidence of getting somebody into a deal out of state is huge, because that's the last thing you want, is to spend money on, inspections and appraisals and all this stuff, and get to the end and go, oh, sorry, we can't close you. We didn't actually, do the full qualification up front. That's scary enough going out of state to buy a market, and then having to deal with that just kind of sets a bad tone. So, absolutely, we have to have people talk to our lenders right away. That's pretty early on. And then we can kind of move on with the strategy, because the additional part of the strategy is price point. And they need to get that from you. And then also we're getting, your average interest rate. They're not locked in yet, we know that, but we can at least get that number. So then I can plug that into the spreadsheet for them, so that we're actually looking at real numbers.
And that's a great idea, because on the qualifying part of it, a lot of times these guys, when we had a guy from Intel about a year ago, 200,000 on a W-2, he looked solid. He gave us his pay stub, and he gave us a bank statement. That was it. Okay. And it says, well, this guy looks like a slam dunk. And I asked him, is there anything else that I need to be aware of? No. Then we get his tax return. There was a $300,000 loss on a business he decided to open on the side. Completely creamed him. He couldn't even get it qualified. So yes, we do get all the paperwork up front, just to make sure we don't waste anybody's time. Okay. Yep.
Exactly. Yeah. And just to echo that, Graham, when we do, go through the effort of getting that full pre-approval, we can, to kind of echoing on Melissa's point as well, we can then back into, how many properties is this borrower qualified for? Can they go ahead and buy a couple now? One at a time. So we can back into all that information, give them some valuable input as far as, do you qualify? How many do you qualify for, and to what extent? And that communication right from the beginning, with Melissa helping with that, just makes it really smooth and seamless, or for all parties.
Well, I'm assuming, Melissa, you cheated over the years from the standpoint of, hey, this is a great property. I'm not going to share this with anybody. I'm just going to go ahead and buy it. I've had that presented to me several times over by a lot of the providers that I work with, which is a great way to go. So I'm in so many different markets, and I'm assuming you are as well. What are your favorite markets?
Yeah, good question. So, yes and no. People ask me that all the time. They say, oh, you just grab up all the good properties, or, and I'm like, well, I wish. I wish I had unlimited funds. I wish I had billions of dollars and I could just grab up every property. But I don't. And also, we all have different strategies at different times. And so in the beginning, I was more, focused on really high cash flow. Then my strategy kind of changed a little bit, and I was going towards markets that have a little bit less cash flow, more appreciation. And then back. And I think the biggest key is diversification. I think that's really important, because we want real estate to have some appreciation value, because that's really growing the wealth for us in the background. But we also want to be able to have some cash flow on the front end, so that if unexpected expenses come up, we can cover those. So if we have a portfolio that's kind of balanced, it's got a little bit of both, then the portfolio is working together as a whole, and it's working together as a unit. So some of my top favorite markets, I just bought a property in Ohio last month. I love that market. I've always been really bullish on the cash flow markets that are just easy and linear. So markets like Little Rock, Memphis, Birmingham, they're just markets where you don't see these big highs and lows. We're not seeing big volatility. And so right now, where my investors, we don't know what's going on with the markets. Everybody is guessing and saying, this is happening and this is happening. And, we don't know. Nobody has a crystal ball. And so to be able to go to a market that is pretty linear, that, when the market goes up a little bit, it goes up a couple points. If it goes down, it might go down a couple points. But then we have really high rental demand. Some of the markets that we're in have, over 50% rental tenants. And so there's always a demand. Housing is, it's a necessity. It's not a luxury. So those are really popular markets right now. I love them. And, interest rates have gone up just a little bit. We know that. So going to markets that have a little bit more cash flow gives you that extra padding, and, kind of keeps the numbers well.
Right. And we all know that even with the rates being a little elevated, we're only going to marry the property and date the rate. I know you've heard that in the social media forever, but it is true. I personally have got several being built right now, and I can't lock into any rate till I get to the end of the build, and then I get my loan. I'm hoping that the market does start to hit that recession wall, if you will. Hopefully, third or fourth quarter. A lot of analysts are saying yes, some are saying no, and we're all crossing our fingers that the Feds aren't going to do any more rate hikes, and we'll just see. But in the whole scheme of things, it's still one of the best times to buy real estate. So with that, let's just kind of showcase a couple that Melissa has been provided to us. Bear with me just a second here. I'm going to share that screen. Great. Can you guys see that?
Not yet.
Can you see that?
There we go. Yep.
Got it?
Got it.
Can you see it?
I'm on it. Yep.
Oh, perfect. Perfect. I'm going to let you take it from here.
Okay. So one of the things about this particular spreadsheet is this was created by an engineer for me. And I really love it because it shows not only the cash on cash return, which is my favorite number. So I'll go over that with you. But it also shows some of the hidden things that we don't always look at. A lot of people focus on just year one. And I think that's unfortunate because, like I've been saying, there's so much more to real estate. And this really is a long-term strategy and a long-term wealth machine. So this is a nice B-class property in Cincinnati. All the properties I believe in, like I said before, passive. So these are newly renovated. So that's the expectation. And number two, the other expectation is there is a local property manager in place that is going to manage and do everything for you. So this rental quote comes from the property manager directly. So we've got a nice purchase price here, $154,900, monthly rents of $1,500. Then we've got all the important numbers. We've got the fixed numbers, which is, property taxes are on there. Insurance is on there. Insurance is always going to be, an estimated rate because you could work with 10 different insurance companies and they're going to give you different quotes and different add-ons. This is a number we know that you can get on this property because it's just an example. It's a standard, basic policy. Then we've got the property management fee on there. And then what I like investors to do is I'm going to actually have you guys look. So we've got total cash invested, which shows about 20% down, plus an estimated closing cost. Now, I like to ask, I want to know how hard my money is working for me. So when we go to a bank or we go to you guys and we say, hey, we want to take out a loan, you go, great, put down 20%. We're going to pay for the other 80%. So a lot of investors run the numbers on that full number. I want to know how hard my money is working for me. So that 20% that I put down, how hard is that working? And that's what the cash on cash return is. So we take all of those expenses, and on this property, the monthly cash flow shows at $423 a month. Awesome cash flow. Now that's fixed expenses. That is not assumptions. And I can kind of cover that in a second. But so this property is earning year one a 14% cash on cash return. That means that $35,000 that you invested in this property is earning 14% year one. That's why I like to use it, because then you can compare properties a little bit easier when you're comparing property, Indianapolis to Birmingham to Memphis, wherever is, we can kind of, they all have different price points. I like to look at that number. Then I automatically jump ahead to year 5. We want to look ahead a little bit in the future and see what the returns are going to be. And all of a sudden your cash on cash return is 19%. And that's because of something called rental increases, which is really important. You may not be able to take them every single year. That's a strategy you can work with your property manager, but the potential for that is there. And that's a historical number. So every year that gets better. Then we've got the column above that shows equity accumulation. That's really awesome because that shows the value of your property going up. And it also shows the mortgage going a little bit lower because your tenant is buying you a free house. So we've got that number in there. By year 5, potentially this property could have about $81,000 worth of value. That's wealth that you just created in 5 years. That's phenomenal. And then above that, we have tax benefits that are potentially there for you to take out every year. You got to talk to your CPA about that strategy. And then you keep looking at the column, and then it shows the cash flow there. By year 5, you're at $575,000 a month. That's amazing. Your money is working very hard at that 19% by year 5. I don't think that there's a lot of investments out there that have this type of return. I mean, sure, if you want to take higher risk, but with real estate, there's nothing like it. I'm clearly I'm obsessed.
True, very true. Yeah, the rental increases have been really good in all those markets you talk about. I personally own in all those markets you talk about, and I would just, well, I mean, I just got one today, Dallas, Texas, and it was like, okay, here's where your rent is today, and we should probably be here. Here's the market. And I was off $200. So it's kind of like, gosh, what do? You nail them with $200 or keep them in the place? So I split the difference and went half. The good management companies will allow you to do that. Okay.
Yep.
The other ones that plug and play, you take another look at management. So, well, let's look at another one here.
Yeah, I was going to say that's the perfect strategy that you're working with your property manager to make that decision. At the end of the day, we want to keep the tenant. You know, it costs you a lot more money if you had to switch the tenant out, but your property manager is the market expert. So I agree with that. I just work with them.
Exactly. All right, here's one in Indianapolis, which I love that market. I've got 4 up there myself. So let's talk about that one.
Yeah, so Indianapolis has a little bit more appreciation happening than some of those other markets that we talked about, the Little Rock and the Ohios, maybe just a little bit more. And again, it depends on the area. When you go into a little bit better area, they're always going to have a little bit more appreciation. But historically, we've seen, this property, 144,000. This is going to be, a good area. You're attracting a really good quality tenant at a $1,300 a month rent. That's a pretty big deal. People get so caught up in the weeds of, neighborhood grades. And what I have to tell people is a lot of it is personal opinion. And so there's really no like set formula across the board where everybody goes, no, that's an A, that's a B, that's a, and so the first thing that I look at is the rental amount. What is the type of tenant you're attracting and how much can they afford? And the higher the rents, generally, you have a little bit less tenant risk. And so this is a perfect example. Some, $1,300 a month rent. That's a nice solid tenant. Then we've got all the expenses in there. Now, this one, I did leave off the management fee. If you notice that down at the bottom, because this property comes with free property management for 1 year, which is really awesome. And so I did leave it off for year 1, but I do put it back on. So like when I'm working with you and I'm sharing properties with you, I'll explain that and I'll say, hey, look at the cash flow on year 1. We're sitting at about 16%. Now let's add the property management fee back on. And then let's look at, year 5 and above. So, so don't think I'm trying to like hide something here. I left that off because of that reason. Let's cash flow really well and take advantage of that property management discount. And then, then we'll add it back in. Some of the partners that I work with in some of these markets are also giving some pre-negotiated incentives, just because we know interest rates have changed and they've gone up a little bit. And so in this example, they're giving you a 2% seller's credit at closing. And so that's why I was able to I kind of plugged in a little bit of a lower interest rate there, knowing that they were going to pay for some of your buy down on the rate. So again, I'm just using general assumptions, but when I'm working with you specifically, all these things are going to be pegged in way more detailed so we can, see the real numbers.
Yeah, and one of the things that, excuse me, that we're doing as a company, we recognize some of the challenges that we have today of providing real estate and keeping those numbers as strong as possible, and having the interest rate being a little bit higher and take a little bit more from that cash flow. Once again, marry the property, date the rate, because we also are going to provide a 3-year warranty or guarantee, whatever you call it. If you fund a loan between now and year end, we'll give you 3 years. If the market comes back around, which it will, we'll refinance you. We won't charge you any closing costs. So keep that in mind when you're analyzing these properties.
Yep.
Just
And
take a-
that's, I
Go
would say
ahead.
that's the consensus across the board is, the numbers still make sense and that they look great. In fact, because, I've gone out and negotiated a lot of these things, 2% seller's credit, free property management. The numbers look as good, and you can tell me if you've seen this too, Graham, but the numbers look just as good as these returns as they have been 2 years ago, 3 years ago, 4 years ago, if not better. And we're using those higher interest rates. And people don't realize that. They're like, oh, I'm scared. I'm listening to the news and everybody's telling me all this stuff to be afraid. And I'm like, but the returns are actually the same, if not better, because of all these, amazing things we're throwing out. And sometimes we are lowering the price as well than what it was. So
Yeah,
I'm negotiating the best I can to get these awesome returns.
yeah, just and to echo on that point, Melissa, it really over the past year, we've really quietly shifted into this buyer's market where these buyers have gotten a lot of power back with lenders, with sellers in the form of credits. And there's deals all over the place lately. We're seeing credits, we're getting asked more than ever, hey, what's the max amount of credits I can have? And what's going to happen, Graham kind of touched on, third, fourth quarter, hopefully we're going to see these rates start to, finally turn around when we hit that recession wall. And a lot of these incentives out there are going to start to kind of slowly dry up, just kind of like how they appeared on us out of nowhere.
Yep. So, and also, because there's people out there that are afraid. I mean, don't get me wrong. I mean, we're still extremely busy and my inventory goes very quickly, but, you guys can attest to this, but a couple years ago, I mean, I would show my clients a property and it was gone within like 20 minutes. I'm like, sorry, it's gone. Like you have to be like fast, which is why I'm so bullish on teaching my clients how to read these performas correctly and quickly so that you can make a decision pretty fast. I would say now you have, maybe a day to make a decision versus, an hour. But they're still moving.
Yeah, and to solidify that, I mean, and like I say, Melissa and I cheat, so we don't have to go into the competition. But when those things do get out there and you show everybody what you got, don't wait. Don't wait because there's 20 people standing behind you wanting that same property.
Yep, exactly. And so, yeah, like I said, that's why it's so important to understand, where all these amazing benefits are in real estate. And then you can just look at a property, like my clients that are building portfolios right now, they just know when they see a property like this come across their desk at, a 15% year one, they're like, all right, I'm in, like done. This one's a really nice one. We don't see, these types of numbers that often.
That is so very true. That is so very true. Let's take a look at one more here. Little Rock.
Little Rock, yeah. Oh my gosh. Little Rock is a great market for good cash flow. We see great cash flow here. We see really high rental demand. I think it's over 56% of the population rents. Funny story about Little Rock. It's actually the most landlord friendly state in the United States. And the reason why I say that is because there's literally a law that says you can go to jail if you don't pay your rent. It's an old law and it's not enforced. I don't think I've heard anybody like actually enforce it, but the fact that it's still there and it's in writing and it hasn't been removed kind of shows you how landlord friendly the state is. And the reason why that is so important is because if you do have a tenant default, the tenants know that they don't stand a chance. So a lot of them don't even, they do not want not a foreclosure.
Limits on their credit.
Yes, they do not want that on their credit. And so they will dip out in the middle of the night before you even have to go to the courts because they're going to stand in front of a judge and the judge is going to be like, sorry, no excuse, like you're out. And so you don't even have to usually get that. I mean, I don't even know the last time I heard of an eviction with any of my clients in Little Rock. I'm not saying it doesn't happen, but it's so rare because the tenants know they don't stand a chance. So if they're late or if they're behind, they're going to get pressure from the property manager. And then a lot of times they just dip out in the middle of the night and move out so they don't get that eviction on their credit. So this is a really great market. Now, Little Rock is one of those states where they don't run the tax assessment every single year. They do it every 3 to 4 years. So, so that's why we see really low taxes here. This property was just assessed. And so the taxes are not going to change for another 3 years. So that's awesome. Great property again with the rents here at $12.50 a month. Absolutely fantastic. 4 bedrooms. Amazing. This one would definitely make sense for anybody. Great cash flow property.
Outstanding. I am going to unshare my screen now. Okay.
Yeah, I love the level of depth that pro forma goes into. I
Oh
mean,
my
that
gosh,
is
it's great.
incredible.
It's an
And
awesome
the
program.
forecasting out of what to expect, all types of things. The thing on we've been doing loans in Little Rock for forever, the assessed value updated every 3 to 4 years. I just, all types of tips, and that's great.
Awesome. Well, that's what my goal is to, financial freedom is the goal. I mean, we all want that because we want our time back. And you have to be able to kind of see all those numbers to really get excited about it and understand it and know when that's going to happen. So we can work backwards and plan, whatever stage you're at, whether, I work with 20-year-olds and I work with, 60-year-olds. And there's a plan to still do it. Obviously, I wish everybody started when they were 20. That's, of course, that'd be amazing. We all say that, but there's a path forward for everybody, and you just have to like open up your mind to receive it.
It's never too late. I started at a late age. Like I said, 18. So I'm not going to do the math, tell you how old I am, but it still can be done. Okay. And it's still one of the best ways to create a passive income in your retirement. The market's not doing very good right now. Real estate's been strong for many, many years. And even back 17, 18, and 19, we were selling these properties with very similar type of returns that you're showing here at a much higher rate. This is a no-brainer. You got to forget COVID rates, guys. The bottom fell out. It'll never come back. Okay. But that's okay. It will come down again. It may not go down into the 3s like we saw back then. And I got a couple 3s on some of my investment properties, which I thought I'd never have. But yeah, it'd be, once again, marry the property, date the rate. So Melissa, this has been great. Melissa's also got a YouTube channel that she shares a lot of product and some of her education. And I'm going to give all that information in the description below, as well as how you can contact her. And keep in mind, guys, she's a real estate promoter. She promotes in several different markets. Can't begin to tell you how many people have come to me and said, hey, I'm looking at this provider in this market. I'm looking at this provider in this market. I said, well, look, why don't you look at all the markets and call Melissa, which is the easiest way to do it. Okay. So she represents partners in some of the best markets out there to invest in. So that's really the way to go. Okay. Listen, I really appreciate you joining us today. And any closing words you want to give to the audience?
No, I appreciate being here, and I'm more than happy to just talk to anybody. And there's no question I haven't heard. I've been working with clients in these markets for over 8 years now, and so I don't think there's a situation I haven't heard of yet. I think we can all attest to that. We've kind of seen everything from meeting the deadline for a 1031 exchange, like right to the midnight time. And I think that's the most important thing is working with people that understand all the nuances that come with real estate and how to be creative about it. If people go to a Wells Fargo or like a big bank, they're going to get a different type of an answer than they're going to get if they talk to you guys. You guys just have that ability to have a little bit more creativity, and that's what we need to make deals happen. And so everything from working with your self-directed IRAs to working with 1031 exchanges, cost segregation, LLCs, all of it, you name it. It's all really, really fun stuff, and it can be very overwhelming going it alone. And you shouldn't have to go it alone. We've got amazing people that can help, that are specialized in each of those areas that I work with. And so even just, working with the best of the best people, we can all succeed. And that's the goal.
Thank you, Melissa. All the categories you just identified is what Aaron and I have already identified that needs to be addressed. And so be sure to like and also subscribe to this video, because there's so much more content on my YouTube channel that talks about LLCs, talks about 1031s. We've been there, we've done it. There's mistakes that can be made. So like I say, if you need some additional information, please do not hesitate to subscribe. Melissa, thank you so much for attending today. And like I say, have a great day.
Awesome.